What if I told you that the money you trust every single day, the US dollar sitting quietly in your bank account, the dollar that powers global trade, oil markets, and international reserves, may be entering the most uncertain phase of its modern history, not collapsing overnight, not disappearing tomorrow, but slowly facing pressures that could change how powerful it really is by 2026. This is not a conspiracy theory. This is not social media panic. And this is definitely not clickbait. These are real shifts happening quietly across the global financial system right now. Most people will only realize what has changed after it is already too late. So stay with me, because by the end of this video, you will see the US dollar very differently than you do today. Before we go any deeper, if you want clear, simple explanations of the global economy, money, and financial risks that actually matter, make sure to like this video and subscribe to the channel. This is Global Economy Decoded, where we break down complex financial systems in a way that actually makes sense, without hype, without fear-mongering, and without unnecessary noise. Your support helps this channel reach more people who want to understand what is really happening behind the headlines. Now let us begin with something fundamental. The US dollar is not just another currency. It is the backbone of the global financial system. More than half of global trade is invoiced in dollars. Around 60% of global foreign exchange reserves are held in dollars. Oil, gas, food commodities, metals, and even global shipping contracts are priced in dollars. Most international debt, especially in developing economies, is denominated in dollars. This gives the United States enormous power, not just economically, but politically and strategically. When the dollar moves, the entire world feels it. For decades, this system worked exceptionally well. The U.S. economy was strong, U.S. institutions were trusted, financial markets were deep, liquid, and relatively stable. And most importantly, there was no real alternative. Even after major crises like the 2008 financial collapse, the dollar did not weaken long-term. In fact, it became stronger. During moments of global panic, investors rushed into U.S. dollars as a safe haven. That pattern repeated again and again. But something has changed in the last few years, and by 2026, these changes could reshape the role of the dollar in ways we have not seen in generations. One of the biggest pressures comes from debt. Not normal debt, but the sheer scale of U.S. government debt. The United States is running massive fiscal deficits year after year. Total debt has crossed historic levels, and interest payments alone are becoming one of the largest expenses in the federal budget. As interest rates rose to fight inflation, servicing this debt became dramatically more expensive. This creates a dangerous feedback loop where more borrowing is required just to pay interest on past borrowing. Normally, this would be a serious warning sign for any country. But the U.S. has one unique advantage. It borrows in its own currency. It can issue dollars, and the world is willing to buy them. U.S. Treasury bonds are still seen as one of the safest assets on Earth. But here is the key question moving toward 2026. What happens if global appetite for U.S. debt slowly weakens? Not collapses, not disappears, but weakens just enough to push borrowing costs higher permanently. That would quietly but fundamentally change the global system. Another pressure comes from inflation and monetary policy. After the pandemic, inflation surged to levels not seen in decades. The Federal Reserve responded aggressively by raising interest rates. This strengthened the dollar in the short term, but it also exposed deeper vulnerabilities. High interest rates stress the entire global system. Developing countries with dollar-denominated debt suffer immediately. Banks face valuation losses. Governments struggle to refinance. Businesses slow investment. By 2026, the Federal Reserve may face an extremely difficult trade-off. Keep rates high to protect the dollar and control inflation, or lower rates to protect growth and financial stability. Either path carries serious risks for the dollar's long-term credibility. At the same time, geopolitics has changed the way many countries think about money. The dollar is not just a currency, it is a tool of power, Sanctions, trade restrictions, and financial controls rely heavily on dollar dominance. Over the last decade, and especially after major geopolitical conflicts, many governments began to see this dependence as a vulnerability. If your reserves are held in dollars, they can be frozen. If your trade relies on dollar-based systems, it can be disrupted. This realization triggered a quiet but meaningful shift. Countries like China and Russia are not abandoning the dollar entirely. That would be unrealistic. Instead, they are diversifying, using local currencies for bilateral trade, increasing gold reserves, building alternative payment systems, exploring digital currencies, signing currency swap agreements. Each step alone looks small, but together by 2026, they begin to chip away at the dollar's uncontested dominance. China plays a particularly important role here. The Chinese yuan is not ready to replace the dollar globally. Capital controls, transparency issues, and trust limitations remain major barriers. But China does not need to replace the dollar to weaken it. Reducing dollar usage at the margins is enough. Oil trade settled in yuan. Regional trade conducted without dollars. Gradual reserve diversification. All of this reduces global demand for dollars over time. At the same time, new financial infrastructure is emerging. Regional payment networks, digital settlement systems, central bank digital currency experiments. These systems are not designed to destroy the dollar, but they reduce reliance on traditional dollar-based channels. By 2026, this parallel financial plumbing could be far more developed and influential than it is today. There is one more factor that often goes unnoticed. Confidence. A currency's power is built on trust. Trust that the issuing country will manage its economy responsibly. Trust that institutions are stable. Trust that political dysfunction will not spiral into chaos. In recent years, rising political polarization, repeated debt ceiling crises, government shutdown threats, and unpredictable policy decisions have raised uncomfortable questions for global investors. This does not mean confidence disappears overnight. Trust erodes slowly, quietly, and when combined with debt, inflation, and geopolitical pressure, even small cracks can have large consequences. This is where many people misunderstand the conversation. Asking whether the dollar's future is at risk does not mean predicting a dollar collapse. The most realistic scenario is not collapse. It is transition, a world where the dollar remains dominant, but less dominant than before. A world where it shares space with other currencies instead of standing alone at the center. And this is where things start to get interesting. In a world where the US dollar slowly transitions from absolute dominance to shared leadership, the rules of global finance begin to change. Volatility increases across markets that were once relatively predictable. Exchange rates move faster and more aggressively, often reacting not just to economic data, but to political speeches, elections, conflicts, and even rumors. Capital flows become far more sensitive to shifts in confidence. Money moves quickly towards safety and just as quickly away from risk. Financial shocks that once stayed contained within one region now spread across borders in new and unexpected ways. For businesses, investors, and governments, this creates a completely different operating environment from the one we have known for decades. For the United States itself, this transition could be deeply uncomfortable. Dollar dominance has long allowed the U.S. to borrow at very low costs, run persistent budget deficits, and absorb global economic shocks with fewer consequences than other countries face. It has given policymakers flexibility that no other nation truly has. But as that dominance slowly weakens, even slightly, the margin for error shrinks. Borrowing costs rise. Fiscal trade-offs become more painful. Political debates over spending, taxes, and interest rates become more intense. By 2026, these pressures could start to show up in everyday economic decisions. from government budget priorities to household borrowing costs and business investment plans. For the rest of the world, the outcome is far more uneven. Some countries may benefit from reduced dependence on the dollar and greater control over their own monetary policies. They may find new opportunities to trade, borrow, and invest using alternative currencies, but many others could face serious challenges. Capital flight, currency instability, and inflation pressures may become more common. Developing nations with large amounts of dollar-denominated debt remain especially vulnerable. If the dollar stays strong while global growth slows, debt burdens become heavier and harder to manage. If the dollar weakens sharply, local currencies can fall, import prices rise, and inflation accelerates. In either case, there is no painless path forward. This is why major global institutions increasingly warn about financial fragmentation, a world divided into competing financial blocks, different currencies dominating different regions, payment systems that do not fully connect with one another, less coordination between governments and central banks, more friction in trade, finance, and investment. By 2026, this fragmentation could become one of the defining characteristics of the global economy, reshaping how money moves and how crises unfold. So what does all of this mean for you personally? Because this is not just a topic for economists, policymakers, or financial professionals. The dollar influences inflation, interest rates, job markets, housing affordability, investment returns, and even geopolitical stability. Whether you live in the United States or outside it, movements in the dollar affect your purchasing power, your savings, and your financial security in very real ways. If you are an investor, understanding these trends helps you think more clearly about diversification and long-term risk. If you run a business, it affects costs, pricing, demand, and exposure to currency swings. If you are simply trying to protect your savings and income, it shapes inflation, wage growth, and the value of money over time. The future of the dollar is not an abstract debate. It is deeply personal, and it touches almost every part of economic life. At Global Economy Decoded, our goal is not to scare you or predict dramatic collapse. It is to help you understand what is changing beneath the surface so you can be better prepared. The financial world rarely changes through sudden, dramatic events. More often it shifts gradually, quietly, and then, one day, feels completely different. By the time headlines scream crisis, the most important adjustments have already taken place. So what should you watch closely between now and 2026? Pay attention to U.S. fiscal discipline, or the lack of it. Watch inflation trends and how the Federal Reserve responds to them. Track how much global trade and finance gradually moves away from the dollar. Follow central bank gold purchases and reserve diversification. Observe political stability and institutional credibility, not just in the U.S., but globally. Together, these signals tell a much deeper story than any single headline ever could. As we move toward the end of this video, I want to hear from you. Do you believe the U.S. dollar will remain largely unchallenged through 2026? Or do you think we are entering a more unstable, multi-currency world? Share your thoughts in the comments. Your perspective adds real value and helps others see this issue from different angles. If you found this breakdown useful, share this video with someone who cares about the future of money, economics, and global stability. These are conversations more people need to have now before changes quietly reach their wallets and daily lives. And if you have not already, subscribe to Global Economy Decoded for more clear, simple, and honest explanations of the forces shaping our financial future. The world economy is changing, and understanding it is no longer optional. It is essential. Thank you for watching, and I will see you in the next one.